After natural gas recently witnessed this corrective movement from this resistance at around $3.5, we've reversed from this trend line to the upside once again and are currently moving in this area between this resistance at around $3.3 and this support at around $3.25. But whether we're about to see a breakout here to the upside or to the downside is certainly a question that we can only answer by not only taking a look at those technicals, but also at the fundamentals, macroeconomics, and geopolitics of this commodity. From the technical perspective, we do obviously are currently seeing this divergence here between cumulative volume delta and natural gas. Natural gas is moving to the upside as cumulative volume delta is moving to the downside and is showing you that bearish aggression is actually absorbed, as we're currently seeing this bearish aggression actually starting to strengthen and still seeing this upwards trend here at natural gas. We're also seeing that here with the visible range volume profile, that we're currently seeing that volume is actually decreasing here as we're moving to the upside. And so we at Chronos could obviously suspect to see this corrective movement here to the trend line once again. But as we've just mentioned, to really understand the trends that we're currently witnessing here at natural gas, we have to take a look at the macroeconomics, geopolitics, and also fundamentals concerning this commodity. And so let's first have a look at what is currently happening in the Strait of Hormuz in the Middle East, in the Gulf region, because there are new news. We do see that Qatar's liquefied natural gas export are collapsing. You can beautifully see this on this chart here. And obviously, what is that actually signaling? We do obviously have supply disruptions sternly persisting, and there is no way that you can kind of interpret that as a bearish factor. It is certainly bullish. We do see that the 10-day moving average of Qatar liquefied natural gas exports is down just 33 tons, and that is actually the lowest since the 2008 great financial crisis. In fact, we do have seen a minus 90% drop since February, and that's really quite significant in our eyes at Chronos. And why is this so significant? Well, Qatar is the second largest LNG supplier, and it is responsible for around 20% of global deliveries. Even though we are obviously seeing a lot of it going to Asia, we are also seeing American prices of natural gas being disrupted to the upside. And we expect to see volatility, as we've now seen it in the last few days, obviously to continue as we're seeing this war in the Middle East. But we like to take a look at the weather conditions as well, because we are seeing that it's getting a little warmer here in the North American area. We do see that essentially here in Florida, but also in Texas and California, we do see some spikes up in temperature in this week here, and also in the next week, we do start to see some higher temperatures actually starting off here in the USA. But we're also seeing that Asia is quite interesting, as we're seeing not so much happening in Europe. Europe has neither really high nor really low temperatures right now. And so if you have a look at China, you can beautifully see that India is actually having quite high temperatures. And whenever you do see those high spikes to the upside in temperatures, that is obviously certainly demanding more cooling. And that can also lead to bullish effects at natural gas, especially now that obviously we've just assessed the fact that a lot of LNG natural gas from the Gulf region is actually exported to Asia. We obviously see that supply to this region is slowing down and demand could actually increase, as we do see those high temperatures, not only here in India and Bangladesh, but also in the south of China. And so concerning the weather and concerning the geopolitics, we remain quite bullish, but we do expect volatility to remain quite high. But to really understand the longer term cycles, to zoom out a little bit and have a look at the broader picture, we have to take a look at the weekly chart of natural gas and some other macroeconomic indicators. And so if you like this approach of taking a look at those cycles to learn from them, please make sure to subscribe to our channel, like the video, and also support us by writing a small comment or just answering a question or asking a question or anything like that. We would really appreciate that. Thanks for your support. Now let's have a look at the weekly chart here at natural gas, and what you are maybe already seeing is that we do have divergences appearing at natural gas and the copper to gold ratio before we see those crashes happen. We've talked about that in earlier videos. It's quite important in our eyes because that has been a quite successful strategy and signal to predict those sell-offs here at natural gas. We've seen that divergence where natural gas has been moving to the upside and the copper to gold ratio has been moving down to the downside here before the great financial crisis happened, before we've seen that sell-off actually happening here in 2008. We've seen that massive sell-off actually ultimately happening after we've seen that divergence, but we've also seen that divergence happening before the crash or this sell-off happening here in 2011. We've also seen that divergence here in 2014. Even though it was certainly slighter, we have actually seen that not overlapping so much in this case, but we are currently seeing a divergence happening once again. We've seen that the copper to gold ratio certainly has been in this long stretching downward trend for quite some time now, as we've also seen it happen to the upside with natural gas. And so we are currently seeing this divergence, and now you may ask the question, why is this ratio, this copper to gold ratio, so important? Well, what you're currently seeing here with this ratio is just a comparison between the industrial demand and the safe haven asset demand, because copper tends to be of industrial utility as gold is actually more of safe haven asset and security demand. So when you do see those risks actually start off, and when you do see economic stress, that leads to gold outperforming copper, and you do see this ratio falling. Now that's exactly what we've seen so many times, and in fact we have seen that long stretching downward trend for quite some time. And that is obviously really signaling some bearish pressure here at natural gas and generally in the global markets as well. Now, if you combine this with the gold to S&P ratio, it is quite similar, but also beautifully shows you the correlation between gold and the S&P, because the last few times we've seen those crashes here at natural gas, that actually always coincided to this ratio spiking to the upside. It always coincided to gold outperforming the S&P 500. It always coincided to this massive bullish rally here at this ratio, and in fact it did not only happen here with the great financial crisis, but also it happened after we've seen the beginning of this sell-off here in 2011, and several other instances have actually led to some upwards potential at this ratio. Not always as significant as with this great financial crisis, but you can always see this tendency to the upside as those sell-offs begin. Now, as we are currently seeing exactly the same happening once again, exactly history repeating once again, we do have just one more reason to believe that we do have some downside potential in the near future here at natural gas. And what adds on to that is the fact that we are currently seeing this massive reversal here at the gold to silver ratio, as this reversal from this downward to this upward trend also marked the beginning of massive sell-offs in the past. For example, here with the great financial crisis here in 2011, with this sell-off starting off in 2012 and 2011. We've also seen that here in 2014 and in several other instances. Now, it is not always perfectly correlated in time, but it certainly seems to be in causality. And we believe that as the gold to silver ratio is moving to the upside, as gold is outperforming silver, that is obviously just one signal adding to the list, what we're currently witnessing, and we do believe that we're currently witnessing history repeating once again. And now, if we have a look at the specific chart right here, which is the S&P 500 divided by the unemployment rate squared times the US interest rates year over year times the US inflation rate year over year times the US interest rates, and that divided by the M2 money supply. When you do actually formulate this formula, which obviously looks quite complex, but it just beautifully takes into account all of those economic metrics, and puts it into a chart. And historically, whenever this ratio has been falling, whenever we've seen that actually go to the downside by a lot, that actually always led to recessions, right? And we've seen it here with the dot-com bubble, we've seen it here with the great financial crisis, and we're currently seeing it happening once again. And now, the recession basically never really started at the top of this ratio, but when we've already seen some weakness at this ratio. And as we've seen certainly some weakness happening, we believe at Chronos that the risk for a recession coming up next is certainly not quite low, but rather quite high concerning this ratio and this chart. And what we like to add on to that is the spread between the US 10-year yield and the federal funds rate. And so whenever you do see those term premia rise, whenever you do see that convergence between the federal funds rate and the US 10-year, in other words, when you do see the red line cross from the upside below the candle chart here, whenever you've seen that happening, for example here with the dot-com bubble, that's actually beautifully marking the beginning of the recession that we've seen here in the beginning of the century. We've also seen that happen here with the great financial crisis, and we've also seen it happen with the Corona crash. And as we're currently seeing yields of the 10-year bonds being higher than the federal funds rate, that certainly suggested we do see that a recession might be happening next year in the USA. And so if you all combine those data points, if you just combine this empirical evidence that we've just assessed, you cannot have a different view on the current market situation than to be a long-term bearish trend. Now, we've just discussed the fundamental bullish factors such as geopolitics and weather. They certainly are bullish, right? And we can see some bullish developments here in the short term, essentially also with a lot of volatility. But in the long run, we are seeing that not only the technicals, but also the macroeconomics speak a more bearish language. And in fact, we do see that divergence already appearing here with cumulative volume delta moving to the downside as natural gas is moving to the upside. And that just beautifully shows you that sellers are starting to get absorbed. We're seeing sellers pressure rising, but we're not seeing that being reflected in the chart again. And so ultimately the chart seems to follow cumulative volume delta. Natural gas prices seem to follow the seller's aggression, and we expect to see this shorter or later basically play out in a short-term, in a long-term bearish trend. So long-term we are certainly bearish. Short-term we expect price volatility to the upside, to the downside. And I hope you enjoyed the video. I hope you learned something new. Please make sure to subscribe to our channel and hit the like button so you support us and don't miss the next few videos. Also, make sure to don't hesitate to ask questions in the comments or just give us your opinion concerning current natural gas prices. You can also check out our Discord server to connect more to like-minded people. Thanks for your support. See you next time. Bye bye.